Hey, Sean. So I've been getting a lot of questions from clients about tax treaties. Can you break down what they actually are?
Absolutely, Danae. Tax treaties are agreements between countries so that their taxpayers can avoid double taxation on the same income and to help prevent tax evasion. They determine how income like interest, dividends, royalties, business profits gets taxed when it crosses borders. We currently support at TAINA withholding rates based on treaties between the US and other countries.
So if I'm a payee receiving income from the US, how do I claim treaty benefits?
Well, as a payee, there will be a payer of income. If you remember the three P's, payer, payee, payment. The payer of income will request a form W-8BEN or W-8BEN-E, depending on whether you're an individual or an entity. On that form is where you're then going to certify your country of residence, provide a tax ID, and if you're an entity customer, you'll have to probably provide a limitation of benefit provision, which would be applicable to their circumstances. What can get complicated is if the payee is also eligible for a greater reduction in withholding, in which they will claim a special treaty exemption. To get that special withholding rate, they'll need to cite the specific treaty article and that reduced withholding rate, which applies to the specific income type that they're going to receive. These are unique based on each treaty.
And what then does the withholding agent need to validate to apply the reduced rate?
So the withholding agent who receives the forms or the payer of income needs to confirm a few key items on the form. First, that the form is complete and signed and valid. Second, that the payee's country has a valid treaty with the United States. And third, that there is a U.S. or foreign TIN and is valid. And those are required for most payment types being made. And then if there's a special claim, that the treaty article is accurate, the rate claim also matches that treaty article, and that the income type is listed out with an explanation of why they're eligible for that reduced rate.
That sounds like a lot of moving parts, Sean.
It really is, but also remember that getting it wrong one way can open your firm up to financial penalties because you've under withheld based on the documentation you have. But then getting it wrong the other way can cause reputational damage with your customers because you're potentially over withholding. So getting this right is a very important part of our clients' onboarding obligations.